Welcome to 3 and 3. Today we're going to be talking about reserve currency, buyers of US debt, and patience. So, reserve currency. To contrary to what you've been hearing in the news, the US dollar is again the global reserve currency and it has remained over 50% for decades. There's always going to be some gradual diversification by central banks. Countries hold US dollars in their reserves for several key reasons. Trade and payments. US dollar is the primary currency used in global trade. Economic stability. Dollar reserves provide a buffer against economic shocks. Exchange rate management. By buying or selling dollars, central banks can influence the value of their own currencies. As a safe haven, so during times of uncertainty, having dollars is a sign of strength. Meeting international obligations. So dollar reserves are used to meet a country's international financial commitments. Confidence in investor insurance. Holding significant dollars reserves projects financial strength and stability. Inertia and network effects. The global financial system is deeply entrenched in the use of the dollar, making it difficult and costly for countries to shift to an alternative currency. So looking at the third quarter of 2024, you can see the US dollar is at 58.2% of the reserve currency and euros at 19.75. So buyers of U.S. debt. So foreign buyers acquired 290 billion in U.S. Treasuries in February of 2025. That's the second largest monthly increase since 2011. And holdings reached a historic high of 8.8 trillion. So Japan added 46.6 billion, reclaiming its position as the largest foreign buyer. They actually now currently hold 1.13 trillion. The euro area bought 52 billion, pushing total holdings to 1.83 trillion, an all-time high. Canada reversed January sales with 46.5 billion in net purchases, likely again drawn to higher US yields. And China increased holdings by 23.5 billion. So as you look at the US Treasury yields, which are over 4%, and you compare that to Germany at 2.5, Japan at 1.2, and Canada at 3.8, you can see why people are actually buying treasuries and buying those in dollars. So looking at all the countries that are buyers, you can see everybody had positive increases in February. So patience. As Warren Buffett noticed, the stock market transfers money from the impatient to the patient. Success favors those who let time and compounding work. History shows stocks have recovered and delivered long-term gains. And market pullbacks, again, happen frequently. Even the deepest drawdowns tends to snap back very, very quickly. So stock market pullbacks typically see near-term recovery. And S&P index pullbacks of at least 15% since 1975, you can see, have averaged a 39% return over the next 12 months. And you can see the most significant draw being from October 2007 to March of 2009, which was 56.8%. But over the next 12 months, we averaged a 69.3% return. And again, in that COVID period, which is a very short term and kind of blip on the radar, we did see a drawdown of 33.9 and a 73.8% recovery. So despite market pullback, stocks have typically risen, as you can see, over the long term, looking at many different crises, from Black Monday, the Persian Gulf, the Asian financial crisis, sovereign debt crisis, Brexit, COVID, you name it, invasion of Ukraine. It's better to stay invested and be patient over the long term. Thank you for joining us for 3 and 3.